Saudi Arabia's oil policy is very important for the global oil market. This year, Saudi Arabia has increased its oil production to record levels, and it's re-established itself as the largest crude oil producer in the world. This stands in contrast to previous times when the oil price dropped sharply when Saudi Arabia cut back on its oil production. But equally as Saudi is very important for the global oil market is also very important for Saudi Arabia. Export revenues are about 85% derived from oil, and also oil is very important for government fiscal revenues, accounting for over 90% of these revenues. And if we look in terms of economic growth, oil is also very important here. The oil sector accounts for about 40% of GDP, and the fact that the government has oil revenues allows it to increase its spending, which has been a very important driver of the non-oil sector of the economy. Well, Saudi Arabia has increased its government spending quite sharply in recent years, and this has meant that the break-even oil price, that is the oil price that's needed to balance the budget, has increased to over $100 a barrel. But at the moment, a barrel of oil is selling for less than $50. So this means that the government is running a very large budget deficit, and we're projecting that deficit will be about 20% of GDP this year. Now, the good news is that the government has been able to build up substantial deposits in the banking system and has paid its debt down to very low levels. So this means it can either run deposits down or issue new debt in response to the decline in oil prices rather than sharply cut back on government spending. However, if we look forward, a strong and sustained fiscal consolidation is going to be needed. If this doesn't happen, then the fiscal buffers that have been built up will be eroded very quickly and fiscal risks will rise. We expect that growth will slow because of the drop in oil prices and also the expectation of slower growth in government spending. And yes, this will definitely affect the operating environment for the banks. However, banks in Saudi Arabia are very profitable. They have high capital and provisioning levels, low levels of NPLs, and also they're very liquid. And then the central bank has also been tightening and improving on the regulation and supervision of the financial sector in recent years. So we think all of these factors put the banks in a very good position to weather lower oil prices and weaker growth. I think really it's creating jobs for the growing working age population. If you look at the next few years, we're going to see a continued strong growth in terms of labour force entrance. And these people coming into the labour market gives an opportunity, if they can be productively employed, to give a good boost to growth. But of course, if they're not employed, then we're going to see an increase in the unemployment rate, which is already at 11.75% for nationals. Currently, we see most of the nationals working in the public sector, and then the private sector is very reliant on expatriate workers. Given the fiscal challenges ahead, they're going to have to look increasingly to the private sector for jobs. Now, the government's been implementing many labour market reforms in recent years, and we're already seeing some effect from that. And if we look over the last couple of years, we see stronger growth of Saudi employment in the private sector, stronger growth than we're seeing for the non-Saudis. But there's still some other stuff to do. One of the things that hasn't been tackled yet is the relative attractiveness of public sector versus private sector employment, particularly for the lower skilled. And we also think further efforts are needed in terms of diversifying the economy away from oil to create high-paying, high-productivity jobs in the non-oil traded sector.